attracting private investment into renewable energy, into microgrids, or into electrification. Oh, that's me. Working? Not working. Okay. And I'm struggling a bit with what to say, to be honest, because I'm not a microgrid expert myself. I think I learned more than you're going to learn from me already. But I'm rather going to talk a bit about finance issues. I would say I'm an energy policy expert. Do a lot of stuff in developing countries, renewable energies in developing countries, mostly on-grid. I did supervise a PhD student, though, working on village grids in Southeast Asia, and I'm going to have some insights from that. But it's, as said before, as you said before, it's quite similar learnings as we have had in the other presentations. So also in Indonesia, we see similar issues. But let's start with my agenda. First, I'm going to talk about the potential role of private investors and why I think it's so important to think about private investment. Most of the grids are currently grant financed, right? Then I'm going to talk about how do private investors work. This is one, probably the most important decision-making rule. I'm going to do that a bit. Then the grid study, the case study in Indonesia. Talk about return and potential additional sources of return besides selling electricity to households and businesses. And then I'm going to talk about sources of risk. And then finally, as risk is so essential, as you learn in part 2, ways of how to address risk. Okay, let's get started with the potential role of private investors. This is a very complicated chart. I'm not going to go into all the details. Don't worry. This is provided by the Climate Policy Initiative. This is climate finance, not microgrid finance, but I don't have something like that for a mini-grid. So if someone of you, perhaps I'm going to put up some challenges, I thought, for you guys, for the mini-grid research community. If someone could do something like that, like where does finance come from in mini-grids? Where does it flow? Where does it end up? That would be fantastic. They do this for climate finance, and what's interesting about the slide is those boxes. The green box is public finance. The yellow box, which you can hardly see, is the carbon markets. And the red part is private finance. So already now, in climate finance, there is more private finance than public finance. It's a leverage of about 1 to 2. That's the relationship. I'm going to use the word leverage quite a lot. That's very typical for finance. You use it as well. So it just means by how many times do you leverage some input. As I said before, I don't have any numbers on my mini-grids, but we have heard one number already twice before, and that is those 43% from the IEA. So if you want to provide electricity or clean energy services to the global population by 2030, we need to invest, I think, $700 billion by 2030. 700 billion, and 43%, according to that study, is going to be into mini-grids. That's $300 billion. Any government is going to provide that? Any public funding? I don't think so. Especially no domestic public funding, because that's typically very limited in those countries. But also internationally, I mean, governments are actually quite broke, I would say, internationally, so they're not willing to spend that. Carbon markets, I'm going to talk about that in a second, but they're very limited as well. So for private funds, for private finance, 300 billion by 2030 is nothing. It's peanuts. Every year, institutional investors alone, I'm going to talk about what institutional investors are and why they are so important in this regard. Every year, institutional investors alone invest 70 to 80 trillion US dollars. So 300 billion by 2030 is not much.
Change. It's change. It's a change.
Yeah, you're right. It's peanuts. So the question really is, how can you attract private finance, and how can you, that's what I'm indicating with this blue arrow, how can you leverage private investment through public finance? To talk about that, I think it's important to understand how investors work. And I think it's two important things, and we've heard this word quite a lot, and it's return on investment. We had it in many presentations. But investors also care a lot about risk. And that's, I think, a bit different from grant money. If you're providing a grant, the money for you is lost. So you don't care. You want that things happen and stuff, but you don't care about the exact risk. But in private finance, you really do. And those two variables are, of course, not independent. They're typically related in this way. So even for a risk-free investment, you have a risk-free rate, which is currently close to 0, and which is typically determined by the US dollar bond. And then the more risky an investment gets, the more return you want to see. That's this risk premium there. And this blue line indicates a threshold, and every project that's above that threshold would be an attractive investment, and every project that's below would be an unattractive investment. That's the key decision-making rule. It's the so-called risk-return profile of an investment opportunity. So where in that matrix, where in that is an investment opportunity? If it's here, I'm not going to invest. If it's here, I'm going to compare it to alternatives, and then you choose the alternative that's most to the top left. I'm very happy that you introduced the LCOE and how they are made up in your presentation, because it's a perfect build-up on this. This is very similar to what you have shown, especially this one. This is very similar to what you presented on diesel. So this is how the life cycle cost of renewable energy. This is grid connected. Again, I'm not the expert in microgrid. I don't have the numbers on microgrids, but I'll come to microgrid numbers later. So this is how the costs are made up, and you see this dominance of the fuel cost in the gas case, and you see the dominance of the capital expenditures and the financing cost, the cost of capital in case of renewables. This is a developed country context. This could be like Germany or the UK. If we now keep all assumptions the same, except for the higher risks that only stem from the case that we're in a developing country now, this is what happens. Gas or diesel hardly suffers, whereas renewables, because they're so capital intensive, their costs increase by 40%. And the only thing you change is really the cost of equity and the cost of debt. There is a systemic disadvantage for renewables due to their high capital costs in risky environments. And all the mini-grids we were talking about are in very risky environments from an investor perspective. This chart is telling the same. It just gives you a number. It's all this technology there. The renewables, they all suffer strongly from higher risks, from higher capital costs in terms of their life cycle costs. Whereas the more fuel cost intensive we get, the less we see this effect. And diesel can even be negative due to discounting effects. So, typically, mini-grid projects, I would argue, are here. So there's two ways now to bring them in the green zone, right? One is to increase the return, and one is to reduce the risk. Let's talk about those two levers. To this end, we have to understand what risk means. I mean, I'm not going to talk about return. I think everyone knows what return means. But risk is actually defined as the combination of probability that a negative event will happen, and in case it happens, the negative impact in terms of financial impact. And this probability is driven by variables in the investment environment. So there's actually two ways to address risk. One is to transfer the risk to another party. That's what we call financial de-risking. That's from the UNDP work that I did. And that's like a car insurance. You can have an accident insurance, And then you transfer, in case you have an accident, it's not you who has to pay for the repair of your car, it's the insurance company. That's transfer of risk. But the probability that you have an accident will not be affected. What you can do is you can also remove barriers in the investment environment, like better cars, better driver training, and so on, in the metaphor of the car accident. And that will reduce the probability that you have an accident. So and that we call policy de-risking instruments. So there's two ways of addressing risk. So let's look at a more concrete example how this could play out for mini grids. Let's look at the return first. But before we do so, I'll just quickly introduce you to the situation in Indonesia. So Indonesia has about 17,000 islands, and 6,000 of them are inhabited. And here you see the electrification rate, and you see that it's quite relatively high in the western part of the country. The further east you go, the less electrified are the people, especially also these small islands here, where there's no data typically, you hardly have any electrification. So the overall electrification rate is about 70%. That means 70 million people are without electricity. And almost all of those are in rural areas. So I think it's a very classic case. What's interesting is that up to 2009, it was a monopoly. Only the state-owned utility company could do electrification, but in 2009 that was changed. Now also rural cooperatives can provide electricity. So it already has to be community-based. That's the case by law. However, we still don't see a lot of diffusion of microgrids. So that's a starting point for our study. Why is that the case? Are there not enough returns? Are the risks too high? The baseline, by the way, in Indonesia is diesel-based plants, and that is because there are massive subsidies for diesel. I think perhaps some of you have read that in the newspapers. Indonesia is one of the countries spending the most money on diesel subsidies in the world. I think when the oil price was a bit higher, I think 2-3 years ago, they spent 5% of their GDP for diesel subsidies. And I'm currently working with Lebanon, and that's 7% there. And I'll come back to that. So when we look at the cost of mini grids, this is our estimate here for Indonesia. So if you have good hydro potential, you can reach $18 per kilowatt hour, and if you don't, and if you rely on solar and battery, and that's 24-hour electricity, by the way, you reach about 70 cents per kilowatt hour, which is quite expensive. That is assuming a WACC was just introduced, of 12.5%. That's very high financing cost. But that's the case. That's the case there. Because you will hardly find a bank stepping in and giving you a low-cost loan. So first let's talk about revenues before we go further into that. So let's compare those costs with potential revenue sources. And we did not only look at the local revenues, but also national and international revenue sources here. So let's start with the classic, local, the willingness to pay. It's about 18 cents. And that's, by the way, that number is based on real projects in Indonesia. And that's more or less the average, and you see the upper and the lower bound there. So if you are in the lucky situation of having good hydro potential, you're actually about there. But if you're not, you need additional revenues. And what we said is, the national level, or at the national level, there could be support from the government, because the government is supporting diesel-based electricity generation. So why not? And by the way, diesel is without subsidy somewhere here, with subsidy somewhere here. why not take that money and just redistribute it? Phase out of subsidies is kind of the hardest task you can probably do, but redistribution could work. So that would be another 30 cents. Then they also have a huge electricity subsidy for grid-connected electricity generation, because the electricity price for a grid-connected consumer is only 10 cents. So it will be somewhere here. But the cost, even for the grid-connected electricity, is much higher than that. So there's another subsidy. And you could also provide that subsidy to microgrids, and then that would be, on average, another 38 cents. Internationally, we looked at carbon markets, and we actually assumed a relatively high carbon price. That's, I think, $12.50 per ton of CO2, assuming gold standard, which is probably the highest carbon price you can get at the moment, but hardly any contribution. So in total, there would be enough revenues, but of course this is dependent on national policy. So let's quickly look into the risk side. Also here, we split these what we call governance levels. The local level, the village level, the national and the international level. And there's a whole list, and I'm not going to go through those, of barriers which drive the risk. If a bank sees those kind of things, they're like, okay, I'm not going to give you a loan in a good condition. How can we address those barriers? And the barriers are exactly the same or very much overlapping with what we've heard all over the day. So how can we address them? Here's the same list, and here's a whole list of proposals how to address them. I'm just going to go into one, and we've heard that before as well a lot, and that's this uncertainty in the electricity demand, and especially also the growth. So what I'm saying here is some of those risks can be actually addressed by the business model. We heard that. I think we heard it twice or 3 times already. If you have a business model which allows for scale-up, which is modular, which is flexible, that takes out the risk of this bottleneck and congestion of the grid. That's one example where it's really the investor, the operator, that has to address that, or can address that risk, and should address that risk. But, and that's my final slide, I think there is also a lot of risks that cannot be addressed by the investor himself, but that has to be addressed by policy, or let's say the public side. And first of all, that's the energy market risk. If you have such high subsidies and so on, that can be a problem. We also heard about high taxation of electricity before. Institutional risk is a big issue. Getting the licenses to build the plant. The technology risk, we talked about the technology standards quite a lot, so I'm not telling you anything new. And then the financial sector risk. And I think that's a very interesting one, because the financial sector is not familiar with mini-grids. So they're not able to understand the risks, and they're saying, okay, hands off, I'm not going to invest. So I think what's important, and that's probably where I'm going to stop, is to tell you, I think, the 4 things that private investors want to see, and perhaps you're able to look into them. The first thing is, no surprise, I already mentioned it, low risks. And especially institutional investors, those with the 70 trillion want low risk. And those are the only ones who would be willing to invest into mini-grids with their long payback periods. Because other types of investors want to see their money back after 2, 3, 5 years, but they can go for 20 years. Institutional investors are fine with that. As long as, and that's the second point, as long as the cash flows are stable. But I think that's actually a great fit with infrastructure investments per se. The third thing, and that's very interesting, it's very interesting what we heard about that, is scale and replicability. I think one mini-grid, let's say an investment of $200,000, $500,000, it's not interesting for those kind of guys. But if you manage to bundle them, then suddenly you get to a scale which is interesting for them. The guy in New York earned so much money looking into this just a few days, it's already eating away. If it's only 500,000, it's already eating away the profits. And the fourth thing is they want to understand the business model. So simple business models that they can understand and relate to is key. Having said this, I'm not sure whether that fits. Some of the points obviously fit to many with, some of them don't. But I think if someone manages to get those 4 points together, chances are high to tap into private finance. And with that, I'd say thank you, or in Indonesian, terima kasih.
Thank you, Tobias.